Okay, so let's have a chat about capital gains tax. This is an interesting one. So I think begin by just sharing with the listeners, again, I know we touched on it last time, but we didn't have time to get into it really. So share with the listeners, again, just quickly, what is capital gains tax? What's the reasoning behind it? Why does the government want a portion of your capital gains?
Oh, so that they can make money. No, capital gains tax is a tax on capital items. A capital item is usually employed to make taxable income. That can be property, it can be motor vehicles, it can be furniture. It's anything that you're going to use for a long period of time to make taxable income with. So that item itself might not directly be bring you income, but it's an income generator.
Okay, and then so explain the dynamic on when you will have to start paying capital gains tax and how they actually calculate your capital gains, how it's calculated, the inclusion rate and those kind of things. Because I think most people, or a lot of people, think that if they buy a house, a second property, a townhouse or whatever, for 500,000 Rand, and then 3 years later they sell it for 700,000 Rand, they're going to pay tax on 200,000 Rand. And that's not quite how it works. So if you can explain a little bit about that, how that calculation gets done.
Okay, so capital gains tax, it's not a separate tax. It falls within the umbrella of income tax. You only disclose it to SARS once a year when you do your income tax return. So every time that you buy and sell a capital good, you don't have to disclose it to SARS. When it comes to property, you have to give your income tax reference number. That's so that SARS can keep record of it. Specifically, when it comes to property, it's distinguished between a primary residence and a non-primary resident. And each individual in South Africa is only allowed to have one primary residence. So that is your basic residence, where you stay. It's where you sleep and live. And everybody is only allowed one. So there's a little bit more space to move when it comes to primary residence. You get a 2 million rebate when you sell it. So if you sell it for under 2 million, it's not even something to think about.
Okay. So not 2 million profit or capital gain, 2 million value. Done.
Yeah, 2 million value, you don't have to have sleepless nights over it. If you do sell it for over 2 million, it doesn't mean you're going to pay capital gains tax on it. It's just then you need to start thinking about this.
Okay.
Okay, that falls away when you, let's say, for instance, you buy a property for investment purposes or for a holiday home. Then that primary rebate falls away.
Okay.
So there's three terms that needs to be considered when it comes to capital gains tax. It's your proceed. That's the amount that you receive for it.
Okay.
Your base cost, for all intents and purposes, is to simplify it, it's the cost that you paid for that item.
Yes.
And then it's your capital gain. Okay, so you take your proceed, the amount that you've received for it, less your base cost, which is your cost price, then you get your capital gain.
Okay.
Then you deduct your annual exclusions. For primary residence, it's 2 million, and for all other capital items, it's 40,000 per year.
Okay.
So I've got an example here.
Does that, sorry I'm interrupting, but does that accumulate? Or I don't think it does. The 40,000. So if I don't use the 40,000 for a capital gain this year, I can't use 80 next year.
No,
okay.
No.
Just checking. I tried. Just checking. Okay.
It's 40,000 per year. And also when it comes to primary residence, if you are married in community of property, and if you and your wife does not each get 2 million, it's 1 million per primary residence, so that's split into two.
Okay.
Each get 1 million rebate on that or exclusion on that. So let's say, for instance, you have a capital item, you sell it for 200,000 and it costed you 100,000 rands.
Yes.
Your capital gain on that will be 100,000 rands. Then you apply your annual exclusion. Let's assume this is not a primary resident. Then you get a 40,000 rands annual exclusion, which means your taxable capital gain is 60,000. Then there's an inclusion rate, which means only 40% of your of your capital gain is taxable. In this example we just had, it's 24,000 Rand, which will be included in your taxable income.
Okay. So, and that just gets added to the top of all the other income you have. If you're earning 400,000 Rand from your job, you'll just add that 24, and then it will be at whatever your rate of tax is that you will pay tax on that.
That's correct. And your capital gains is aggregate. It means that SARS takes all of your capital gains that you made during the year, add it together, apply the one exclusion. You don't get exclusion per capital item, you only get one annual exclusion. And it's possible that you can make a capital loss. In the event of a capital loss, you cannot offset it against other income or taxable income. You can only roll it over to the next year to offset it against future capital gains.
And how long can you roll that into the future, that capital loss?
Until you make a profit.
Until you make a profit. Okay, so if you make a capital loss on an item, you can indefinitely keep that loss as an asset going forward, a tax asset going forward.
Yeah, you cannot unfortunately deduct it against
normal income.
Normal income.
Okay.